Good evening. It is a Sunday after Thanksgiving, and I am still catching up on videos. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective channel here on YouTube, where I help you make your dreams a reality. Uh, Still continuing these stock market videos about our closed-end fund system, and honestly have no plans to stop. Our closed-end funds system represents just one way we are going to accomplish our dreams. If you want the full system, the full methodology, then head over to Facebook, where I am detailing out our 12 steps to financial freedom. Uh, my Facebook page is called Adaptive Perspective, Navigate Your Finances, and that information will be in the description. So our self-managed, meaning we do it all, but our self-managed closed-end fund portfolio, or CEF portfolio, is built upon lasting dividends, not the gradual sell-off of our own funds or our own shares. So that means the day-to-day, week-to-week pricing fluctuations don't bother me. They don't weigh me down. That's very different from most market advisors and most investors. So our strategy is based upon several facets. We play the long game, and it's a no withdrawal portfolio, meaning if you owned 100 shares of pick a stock, our goal is not to sell those shares. Our goal is to keep that invested, not withdrawing that, and instead live off the dividends. So it's part buy and hold. It's also part rollover. Like if the fund is earmarked to sell at a certain price or a certain gain, then we sell it and then roll that money back into what we're doing. We target 9% plus dividend. That's sustainable dividends and not that 0.5% crap you get with Apple. When it's the fear and greed season, that's a great time to buy. It's a really great time to buy with extreme fear. And then if you buy during the greed cycle, which is where we're at right now, then you want to make certain that you get a really great deal by demanding crazy discounts. And in doing that, we never pay premium. So how do we do that? Some reminders and disclaimers. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. It was the cat witching hour, so we'll see if they make an appearance again. I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone, and I'm okay with that. And tonight, I'm probably going to walk alone in some things I say and recommend. So we do have a specific strategy system when we buy or select closed-end funds. So, and I've talked about that overall in the past, which I'll get into a little bit more in a little bit. But based on our strategy, where would I park money? Like if I'm buying on Monday, where am I buying? Now, maybe the last 6 weeks, I've said bonds, energy infrastructure, and tech. And based on what I would buy Monday now is a little bit different. It's still pretty much the same. I think bonds are great. I think oil and energy infrastructure is great. But I also just think the modern infrastructure of society is a good place to start. So, yeah, where does that leave us? So let me share my screen and share some info with you. So this is the CNN Fear and Greed Index. It's the only thing that I watch on CNN. Not I don't even watch it in that I come to this page and look at this thing and that alone. All the other info they post, not important. So with the Fed slowing its rate climb or stalling its rate climb, it sets off a chain reaction of things. So mortgage rates seem to have actually dropped for the first time in a while. So the Fed pauses rates, mortgage rates stop or decrease a little bit. And I think we're going to continue to see that pause effect over the next several months. Honestly, the Fed likes power and the Fed wants to stay in control. So the more they sell how stable the economy is and when they pause rates, maybe even back off rates, my inclination is that they lower rates right before summer, like right before the move time. And then I think they lower rates again right before the next election cycle. So they can say, hey, look at what we've done with this economy. It was crazy, it was crappy, but we managed it. The economy's in this great position. People have been moving, mortgage, like the housing market's great. We're going to further cut rates right before the election cycle so they get to keep power. But that's me. But what that does in the meantime is, so when they pause rates, people get confident again. Like, I don't have to keep selling, I don't have to keep cutting back. I can now invest. So it used to be over here, like a month ago, it was over here. It was a great time to buy when a ton of people are selling, going, I don't know if I can keep doing this. That's a great time to buy. But now that it's in greed territory, or even if we move into extreme greed when they cut rates, you can't buy just anything. That's when new investors get in and they get horrible deals because they pay premium pricing. Seasoned investors are scooping up crazy deals, but just because you're buying Apple when everybody else is buying Apple doesn't mean you're getting a great deal by buying Apple. And that's why we have our closed-end fund system. So this system, A to Z, when it gets updated next week, I'll find whichever one fund was delisted this past week. So this is 426. I believe it's 425, but there's 426 closed-end funds that average a 9.25% overall yield. Now, some are crazy high, some paid nothing, right? And everything in between. So everything in, say, olive we track, purple is recommended, light blue we own, dark gray doesn't fit our needs, and if it's orange, it's delisted. So that's a ton of different funds to sort through. So back when we were all trapped in our houses, I went through and earmarked everything that, like, I went through and looked at every single fund one by one for things that were interesting. And then over the last 2.5 years, I've improved our system. So we look at discount and then we look by target. And the targets are, so 3 asterisks would be this discount. So if a dollar is break even, like a dollar invested is a dollar a share, or a dollar a share is a dollar invested, that's break even. So if you paid a 1% premium, you're paying $1.01 instead of paying just an outright dollar for that stock. If you're paying that, this doesn't make my list based on when it pays right now, and also the yield is below 9. So so instead of paying $1, you're getting it for 33 cents off. So you're paying 67 cents a share for every dollar invested, which is insane. Like, we all love a great deal, but some of these deals are insane. So the targets are based upon the current discount being double the historical, or at least double the historical discount, and higher than the current 5-year discount. The 5-year discount you can find online. Closed-end Fund Connect, or CEF Connect, you can look at the pricing window, look from inception, and it'll tell you the 5-month history, or the 5-year history. 23 to 18, it's just over 1%. So based on that, you can kind of project what the historical discount is. That's CGO. So is it at 0? No, but it's close. So when the existing discount moves to double the historical discount and is higher than the 5-year discount, then it becomes an exceptionally good deal. Two asterisks is it's on our, like, we own everything in blue. So two asterisks is a dollar cost average move, which that's higher than what we paid for it. So that would be a single. And then one asterisk we're tracking for whatever reason. So instead of sorting this whole list, we're just going to start with this list. Empty spreadsheet. Current would be if we own any current funds. We don't own that yet. So what are we buying and where do I think the market's going to go? This fund is, I mean, it's loaded with great stuff, but based on when it pays and based on its current yield, it doesn't make our list. So all of these are targets just based on discount. So now let's go back and look at yield. We want to target everything from 9 and above. Oops. So that means we can get rid of, I'm not number 3, I need 3. Means we can get rid of this stuff. So what do we want to target? What do you want to target? So I would target bonds. Move this window. So you think of decreasing rates and what should do well. Now, everybody has a theory on where they think the market's going. And in the past, it was accurate. And currently, everybody's got a theory. And I don't know if anybody truly knows what the Fed's going to do or what this market is going to do. The group that I follow and listen to the most is called the Contrarian Outlook. That's who I learned how to filter out closed-end funds from. It's who I learned about closed-end funds from, or I learned about closed-end funds through the Contrarian Outlook team. And they get into their methodology between Brett Owens and Michael Foster. I learned about closed-end funds and learned how to filter them, and then took their teaching and expanded that into this spreadsheet of information. So if mortgage rates are going down, the most common theories I hear, so if mortgage rates are stalling or going down, then the bond market should go up, housing should go up, but honestly, everything should go up. If rates are pausing or backing off, and inflation truly is better, and people have more money to spend, then in theory, everything should go up. Now, you still have to prioritize because that's a lot of funds. You can't put your money everywhere. So where would we go if we were buying? So you have bonds. The bonds is a mix of things. Oil and energy infrastructure. HQL doesn't make it. It's a healthcare fund, but it is an automatic dividend reinvestment program to where you never see the dividends. They get automatically reinvested. So this is our complete portfolio. Every single buy date, what we paid, if we got a good deal or not. This dividend reinvestment, so we get paid dividends. Where are we? So we get paid dividends. So dividends a period. So we get paid $18 a period. And then with that money, the company gives us, in quotes, gives us more shares of the company. In the long run, it decreases that overall price. But in the short run, until you sell the fund, you don't see any of the money. My dishwasher. So this fund pays a dividend every quarter. That money gets dropped into our Webull account, and then pending the money inside that account, it either just sits there or it gets eventually it gets reinvested into something else. This company, I see the money get dropped into my account, and then they automatically take the money back and then give me more shares. That's nice, but that doesn't meet my needs. So the it's not my style. I want that money and I want to invest it on my own. So the smoke and mirrors of, hey, here's money, but hey, here's not, doesn't work. So eventually we're going to sell this fund. When? I don't know. My goal was to sell. We did sell. So we sold AGV. We sold AOD for, I don't know, pretty close to the same price. We lost a little bit overall. KMF delisted uh, and merged with KYN. And in doing so, threw off my ability to accurately track the average share price. These 150, it's like an 88% transfer of shares, so like a not a one-to-one transfer. So it became 123, and based on my current price a share, I had to um, find an accurate number to somewhat hit that current. Like if my current price of share was 950, I could toy with this number, right, until it hit close to that amount. So um, yeah, and this fund will not pay another dividend until next year. HQL. So HQL is a DRIP, dividend reinvestment program, and USA is the same thing. They've recently dropped their dividend again, I believe, to 15 cents. So I would love to sell this and this for near break even. And positive in my favor would be great, but I don't want to sell it for a loss. HQL will also pay a dividend in December, so I kind of don't want to miss that. Now, it's not a ton of money. Like if they both suddenly went up in price and it was past break even and not a loss, then we would sell them and just miss the dividend. But buying more of it, not on my list. Private equity, business development, that could be good long term. The banks could be good long term, but not right now. The goal is to optimize. I mean, the goal in general is to optimize the investment. So I think there's better funds for the market than these two. Oops. Yeah, that one and that one. There we go. EOD, I like the fund, but it's a fluctuating dividend. And it's stocked with the same, well, similar stuff that HTY is. It's just not a consistent dividend. It's not. It has not been all it's cracked up to be. Because I mean, yeah, it's got some bond to it, but what they have off the top 10, you would think they'd be doing great. You look at the distribution history, and it's up and down. And maybe that's the bond component of the fund. Maybe, um, maybe. Uh, I don't know, but for what it is and how it's been, not right now. Calamos funds, even HTY, with tech being higher than normal. Even though this is a great deal, with tech being higher than normal all, like Nvidia, I read today was overvalued. Now they've done a lot. The AI component of everything has really just taken off. But with tech being overvalued, even buying tech at a discount may not be the best idea. Uh, so we're still with bond. That's a mix. This is a mix of bond and others. Energy infrastructure, private equity, business development, and then the Calamos funds. They're very similar in nature. So it comes down to how much money do you have? And with them being very similar in structure, almost to just who pays the better dividend. But it also comes down to money. So we should, in our available funds by the end of the month, we should have that. Uh, which makes it hard to buy this. But if I mean, we're kind of playing a wish list of things. Yes, it's based in reality, but at the same time, my purpose is, or my goal is to give you options. So I would pick the better dividend. And if it's comparable funds, why not pick the better dividend? And as much, if you've watched my videos, you know I like sets of 50. It's just easier math. So when this fund is freshly settled and it's not a set of 50, that's a little irksome to me. So it's tempting to just do that. And that way it gives a new, fresh set of 50. It is tempting. But why I like the spreadsheet is if you type in the shares, yes, it tells you the cost you're going to pay. But it also looks at, you can compare the dividend. I like this fund. I like how it's structured. I like what they do. I like how they're invested. And despite paying a great yield, it's not that crazy of a dividend. So it is the lowest of dividends. My goal has also been to shore up a better, consistent, however you want to say, more consistent monthly dividend. So this is our dividend chart of everything. The bigger size font is the total dividend that we receive from all the individual dividend purchases underneath. So if I look at monthly dividends, my goal has been to increase this. Now it's skewed based on the other funds who pay every month. Like we have funds that pay like these are category 3 funds, so they pay the 3rd, 6th, 9th, and 12th. And it's all relatively the same data. We have funds that pay, 2 funds that pay on the 1st. So the EOD fund, it is a category 1, so it pays 1, 4, 7, and 10. But you start to notice there's a little irregularity, especially between 10 and 1. Now, $10, $20 is not a big thing until you're living off the money and you need that $10 or $20. But this month remains our lowest dividend month just because there's not many funds that pay this month. We used to have a category 2 outright, but it sold and delisted. And I love that fund. This fund, I loved that fund. But alas, they sold the fund out. So my goal has been to increase this to where it's more consistent, but also if I increase, like this is the lowest dividend month. So if I increase this, if I raise this to 150, then everything else raises in general. So as much as I would like to pick up 27 shares here, and it's tempting because I would like the even 400 total share. As much as that's tempting, I don't want that because it's an off month and it doesn't pay it comparatively. So yes, it pays a great yield. It pays a great dividend based on share price. It has a great yield, but in total value of what we're getting every year, it pays the lowest. So what does that leave us with? Honestly, it leaves us with the top three that it's been: bonds, bonds and a mix of other, energy infrastructure, and this one. And this is where I think I'm going to be different than everybody else. So when you think of infrastructure, you think of construction, you think of steel, the chemicals and the equipment to make all the roads. But in this society, this becomes the infrastructure, the technology to do everything, the industrial supply, like all the equipment to do everything, the financial wherewithal of all of those companies to do all the stuff. And then the consumer part of things like Oreo and Heinz Kraft, and that's consumer goods. There are people who would make the case that housing is consumer goods because it's a cyclical product, and that pending your immediate area and housing needs, like where I live around Houston, housing is always in demand. Yes, it somewhat goes up when you're in between school years. It somewhat goes up. The need goes up like around Christmas time because you have 6-month leases. But for the most part, it's a steady supply and demand, and it's a steady demand. Now, if you live in a less traveled area of the country where you don't see that, uh, say, consistent demand of things, where you see a bigger influx of people over the summer, like for school stuff, college town, like I would imagine, I would imagine like college town in Iowa, in the middle of the country, well removed from all the ports of access, you do have an influx of people. But I would wager that you see a bigger influx of people during the summer, whether high school or college, and then winter, same idea. And yes, you have all the manufacturing jobs and the industrial jobs and everything else going on. And there's always a slow need for stuff, but it's not as high as what we see around the Houston area. To where, from my end of things, housing is not a consumer thing. It's not cyclical. It just is. It really ought to be its own section of the market. But some people would still label it consumer. So what I like about this, as much as I would like to round this out, and as much as I think bonds are still a great investment, so this is oops, what we have right now. So my goal has been to hit everything at 200 or more. Now, we had two funds combined. So our we did have 250. We added 123. Now we have 373. It would be great to round it to 400 and then work with other stuff. But since HGLB is still a great cost, and because we have 150 of it, it would be a great time to add 50 shares. The reason I have this on here is as I was digging through funds today. So this is how HGLB is diversified, which diversity, probably a bad way to put it. HGLB is built this way. Some people would say that's diversified. You're spreading your risk. Warren Buffett would tell you diversity is a bad thing because you're limiting your ability to invest in what will succeed. If you, it's like scraping butter over way too much bread. Like it doesn't get into all the cracks and crevices. You take a bite and it's still just dry bread. Versus if you invest where you know you're going to do well and it's butter perfectly spread, then every bite of the bread's great. So HGLB is built this way, where it's predominantly invested in real estate, communication, and energy. And it's got some other stuff spread here and there. It's not a huge fund. And if you look at the pie chart, I mean, it's not a perfect buy, but it's close. You look at CGO, this is where HCLV is. And then you get this added coverage inside the market from a there we are. Still a smaller company, but you also get the Calamos name. Calamos manages a ton of money and a ton of funds. You get the pie breakdown, but with rates dropping and the bond market soon to go up and housing soon to go up, you see how the portfolio is structured. It is potentially curious how things will shake out because there's a lot of should inside the market. There's not a lot of yes, that's going to happen inside the market. So it's where you think the market's going to go. As my uncle says, the market always looks forward. So as weird as it might seem right now, you can't plan. I mean, you want to get the best deal for now. You want to get the best deal that will pay you 6 months to a year from now. But you can't just look in the next year. You have to look in the next 30 or 40 or 50 years. Because whether you like it or not, oil is here to stay. And oil controls all this other stuff. So at some point, yes, we're going to raise that fund. It's just what's the best deal right now for where we are. But oil and who owns it controls everything. It controls the cost of real estate because it costs money, right? And all those products require oil or gasoline or diesel in order to work. All the machines at the mill shops are oil based. They're not green energy. All the construction equipment at the build sites are diesel based. They're not green energy. All the microchips, all the solar panels, all the shingles, all the wood flooring, all of the paint is some type of byproduct of oil. All of the energy market, even if you had a windmill farm over 100,000 acres, every component of that windmill requires oil in order to be made. And every windmill has to have a reserve batch of oil and diesel in order to turn the rotor a certain speed because it's so heavy. It requires oil in order to run and power that motor to where it'll actually turn with the right amount of wind. Right? Green energy, you're plugging your battery into a power outlet. That power outlet is getting energy from somewhere else. That coal plant or wind farm or hydroelectric plant or a nuclear reactor plant, like all of those things are still oil based. And they're still supplying the energy for your battery to do whatever you're going to do. So, like it or not, oil is here to stay. So, we would be foolish to ignore a key investment inside the market. But of where we are right now, where would we invest and where would we invest long term? All of these funds. I'll be different and say that this is important. A little bit more. I mean, consumer stuff will rise and fall based on need. Okay. But tech will always be important. These things will always be important. So where would we invest if we're investing Monday? If we're buying Monday, put it that way. It's a close shot between HGOB and CGO, but the differentiating factor is that we only have that amount of money to invest. So when it comes down to it, right, can't invest there, can't invest there. Could we buy 50 more shares? We could, depending the individual cost. Like if this lowered a little bit, if it dropped back, could we? Yeah. Could we get the 27 shares? Yeah. Could we buy this? No. So if we're buying on Monday, that's what we're buying. Because that gives us the best bang for our buck. It gives us the best deal for what we have. And it's still based upon this entire system. Now, if you're not invested at all, if you don't own a closed-end fund, any of these are great deals. But where would I go if I didn't own anything? Probably here still, because it's the best discount. So you get a great yield, you get an amazing discount. Like who doesn't like 33% off? So instead of paying $1, you're paying 67 cents. And just because this has a much lower discount doesn't mean it's any less significant. It's still based upon the individual funds, historic and 5-year discount. So it's still an amazing deal. It just doesn't look as amazing because the discount is different. But it also comes down to your strategy. The more funds you own, the harder it is to invest in all of them. Meaning you could own 25 different funds, but if you have $500 you're going to invest every month, it's really hard to invest in all 25 funds at the same time. So you have to pick and focus upon the stuff that gives you the best for what you have. And maybe that, HFRO has been at the top for 8 weeks. If you're always investing in that one thing and not investing in something else, is that a bad thing? No. It goes back to the Warren Buffett thing. Diversification isn't exactly helping you. It is if you know what you're doing. Like targeted investment is not diversification. Diversification is I don't really know what the market's going to do, so I'm going to invest in all of this different stuff. It doesn't really help you. The interesting thing about a closed-end fund is it's built like a mutual fund. It's one fund owns all this other stuff. So this is all energy infrastructure. They don't own just one fund. I'll pull it up. And this website only shows the top 10. Right? All of these are really interesting funds. But by buying one, you get access to all. It limits your risk because you're not buying just the one fund. You're getting access to all of them, so you limit your risk. You also decrease your overall price, and you generally get a great yield. So, yeah, in a round convoluted way. So these are the top 4 for the week. So of the 4 in general, they rank. It's pretty much a tie in the top 3. I mean, these 3 get a tie on what is really the best investment right now. The top 4, and I like the 4th. I like the Calamos funds. I offer it really as just an interesting, different take. Yeah, and then strategy wise, if you want a consistent monthly dividend, as much as I love the oil fund, it's not a monthly payer. So let's compare. So It pays 21 cents per quarter, right? So this one has the lowest amount overall. But at 3 months, you're now making more than one payment here. Does that make sense? So if we make all of these 50 shares again, when we look at the dividend of period, right? It's like, well, obviously that would be the most in general, but it's actually not. It's the least because you're only getting that per quarter compared to the others where you're getting paid monthly. So if, all right, so I'll backtrack a little bit. So it's the top four. That's still the top spot just based on discount alone. Everything else is kind of tied at two. Like if you don't own a closed-end fund, that's a great place to start. If you own a closed-end fund and it's not on the list, that's a great place to start or add. And us, we own the top. We own these three. We don't own this one. It would be a neat fund to add. It would be a neat fund to add. But based upon our existing portfolio and the money we have, HGLB or a rounded out 27 shares, where that goes to 400, are the better deals for us. Yeah, and as for you, you need to make. I have a strategy. You need to have a strategy. You need to know what you're looking for. You need to know how you're going to target stuff. If that's by discount alone without any kind of historical reference, if that's yield alone, if that's the overall annual dividend you're going to get, if it's the cost to share, if it's however many funds you're going to own in your portfolio, if it's a target number you're going to try to achieve before you invest in other things. You've got to figure all that stuff out. So for us, the best option, I mean, that's still the best deal, but for us, those fit our needs the best as of Monday. And that's tempting. That is really, really tempting. Like if it dropped, it would have to drop a lot. I'll be honest. Yeah, it would have to drop a lot. But if it dropped, that's tempting. It is. It's tempting. But those are still the best value for us. So instead of me waffling, I'll leave it there. So those are my top selections for the week. If you like the content, if you like my rambling, if you like my different take on things, please consider subscribing to my channel. Hit the like button and then head over to Facebook and join my group there called Navigate Your Finances. The link or the information will be below. So as you face the week, we have, gosh, in the educational world, we have 3 weeks till Christmas break. It will be here before you know it, which means New Year is right around the corner, which means another year is right after that. So wherever you're headed, be the captain your ship needs, because your ship's going to go wherever you steer it. So you better make sure you know where you're going and why. Whatever you have planned for the week, whatever you have planned for leading up to Christmas, I hope it goes well. I hope you make progress. Gosh, we'll see how this market does. I don't know, 4 or 5 weeks till the end of the year. We'll see how it goes. So whatever you have planned, I hope it goes well. If you need help, if you have questions, you can comment here or find me on Facebook. I hope y'all have a great week. Yeah, whatever your dreams, whatever your plans, if it could have happened on its own, it would have happened already on its own, but it's not. So you have to make it happen. So make your dream a reality. Make it happen. and completely shock your world and prove all those jokers wrong. Well, I hope you all have a great week, and I'll see y'all later. Bye-bye.